Good afternoon, ladies and gentlemen, and welcome back. I hope you've all enjoyed your lunch. And we are ready to start with our next session. We're just waiting for one speaker to arrive, and we will start right away. The session is on financing future growth. And for this session, we have with us Shri G. Anant Narayan, whole-time member, SEBI, Shri C.S. Sethi, Chairman, SBI, Mr. Ashish Kumar Chauhan, Managing Director and CEO, National Stock Exchange, Dr. P.R. Jaishankar, Managing Director, India Infrastructure Finance Company Limited, and Mr. Amit Chandra, Founder and Chairman of India Bain Capital Private Equity. Chairing the session is Mr. Rajiv Memani, President Designate CII and Chairman India Region and Chairman Growth Markets Council, Ernst & Young. This promises to be a very, very interesting session, and I request you to all settle down so that we can begin as soon as our speakers are here. Thank you very much. Ladies and gentlemen, please join me in welcoming all our speakers for this session on financing future growth. As I mentioned, we have with us an absolutely brilliant panel, and they're joining us on stage. Request you all to please join me in welcoming them. Okay, Mr. Sethi will be joining us soon. And however, we will begin the session on time. And I'd like to begin by inviting Mr. Rajiv Memani, President Designate CII, and Chairman India Region and Chairman Growth Markets Council, Ernst & Young, to give his opening remarks and take the session forward. Sir.
Hi, thank you. Very good afternoon to all of you. I think it's a real privilege to moderate an exceptional panel. We have the leaders of one of the leading stock exchanges of the world, one of the most experienced regulators, CEO of one of the largest infrastructure companies, and also one of the most seasoned and experienced private equity investors. So it'll be an interesting session. Before, I thought I will just put some introductory remarks and then hand it over to the panel and then follow up with some Q&A. All of us know the Indian economy is in good health, not only in terms of GDP growth, but also in terms of resilience. So when we look at the overall debt, the health of the banks, institutions, corporates, the buoyancy in the capital markets, I think overall the health and the resilience of the economy is pretty strong. And most people, most financial commentators would agree that the economy is well positioned to grow at 6.5% to 7.5% over the next 20-25 years, which would mean that the size of the economy would go up by almost 5 to 6 times over the next 20-25 years. So, but to achieve that, one of the things that is critical is to see, given how the economy is transitioning, is how does the gross fixed capital formation, which is roughly 28% of GDP, that will have to move to roughly about 35% of GDP. And to achieve that percentage, a lot of that will also have to be done by the private sector. If you look at, especially over the last few years, a lot of the infrastructure investment, almost 40 to 45%, has been through budgetary support, coming through being led by the government. But as we transition, it will have to be front-ended by the private sector. And if we look at individual sectors, there was an announcement almost 3-4 years back. The pipeline for infrastructure investment is close to $1.3 trillion. MSMEs have a demand of roughly $1.5 trillion almost every year, out of which $300 billion is fulfilled by the formal system. Some of it goes unfulfilled, and the balance is through the informal systems or the other forms of credit. We need almost $250 billion a year to achieve and arrive at our energy transition goals that we have set up. So each of them have significant demands. Historically, India, if I look at last 20, 30 years, has funded its growth mainly through domestic savings. There's not that much of overseas funding that's come through. But gradually, as physical assets grow, and also there is competition for domestic savings from the government to fund the fiscal deficit, I think we'll have to see how we mobilize more savings into private investments, and also look at more foreign capital and see how FDI increases. And the savings are decreasing, and they're from roughly 20%, they have come to about 18%. FDI has been stagnant over the last 3-4 years, anywhere between 70 to 80, $85 billion. A lot of it private equity, almost $50-55 billion. And if you look at the India share in foreign direct investment, global share, that's about 2.5%. So not relevant to the size of the economy. The other piece in terms of how we look at mobilizing savings better is to see how we develop corporate bond markets. It is progressing, but the way our equity markets are buoyant or structured volume depth, we don't have the same in the corporate market. So both in terms of good quality paper that should be there, and also large pool of investors from a supply side standpoint, I think that has to be there. And also how we open it up more and more for insurance companies, for pension funds, both in India and outside. The other area is in terms of allocation of funds from, especially if I look at the US pension funds, if we look at, they almost invest 50% of their capital in equity markets, about 20, 25, 30% in bond markets, and also about 15, 20% with venture capital funds. In India, depending on your vintage of pension fund, it could be anywhere between 50% to 75% with government. And also, we have about, in terms of insurance, almost 50% has to be invested with government. So how do we open up that pool better will also be interesting. And then I think we will talk about sovereign wealth funds and other things, but we'll leave that to the panelists. My time is the red light is flashing, so I'll have to stop here. But again, I will we will kick it off, and I will request Mr. Anant Narayan, he's whole-time member of SEBI, for his address. Yeah, thank you.
Thank you so much, Mr. Memani, Mr. Sethi, Ashish, Dr. Jaishankar, and Amit. And thank you, CII, for inviting me to the second edition of the Global Economic Policy Forum. Rajiv was mentioning that some of us like coming to the podium and then we don't let go. I'll keep an eye on that timer out there so that I don't exceed my time. What I thought I'll do today is give you a regulator's perspective of this entire concept of financing future growth. What I thought I'll do is look a little bit to the back on one key feature which has been so instrumental in financing growth in the country over the last few years, which is the rise of the retail investor coming into capital markets. And I think it's a huge positive, even in terms of drawing in foreign flows, because of some of the advantages it brings in. From there, I wanted to segue into some of the opportunities and threats and challenges which go ahead in front of us to make the point that there is absolutely no room for complacency to ensure that this capital formation happens and continues to happen. To start with, to remind ourselves, SEBI's mandate is largely threefold. It is investor protection, it is market development, and market regulation. Put together, our job is capital formation, to ensure there is sustained capital formation happening in the country. We are often seen as intrusive regulators with too many laws and too many regulations. That's not just our job. Our job is to ensure that a virtuous cycle of savers coming in, capital being raised, fresh capacity being formed, and therefore more savings coming into the cycle, that virtuous cycle actually ensues. And we have to keep reminding ourselves that capital formation is the cornerstone. Over the last few years, the ecosystem actually has done a tremendous job of drawing in fresh people into this capital formation cycle. March 2020, we had barely 2.2 crore unique mutual fund investors. Today, as of November, that number has crossed 5.1 crore investors. Likewise, in Demat accounts, we had about 3.6 crore unique Demat account holders as of March 2020. Today, that number has crossed 11 crores. It's about 11.4 crores. SEBI as a whole, we look at our ecosystem of individual investors who come in through mutual funds, PMSs, through direct investments in capital markets. The total number of unique individuals who were there at that point of time in March 2020, in some form or the other, was 4.9 crores. Today, that number is 13 crores. It's really grown. And this has been a fantastic story and a full kudos to the entire ecosystem, whether it is exchanges, clearing corporations, depositories, mutual funds, AMFI, brokers, investment advisors, the entire ecosystem. All stakeholders have played their part, including policymakers and regulators. While this is about also how do you draw in, foreign money, I don't know if you realize this enough. This large amount of flow of retail flow coming in, investor flow coming into the markets, actually has had a stabilizing impact in the markets here. Quick, recollection, between October 2021 and June 2022, when Ukraine happened, when the Fed started to hike rates, we actually saw $36 billion worth of foreign portfolio investors going out of the country at that point of time. Any other time, such a large concentrated outflow would have created an impact in equity markets as well as in currency markets. Instead, during that same period, purely in mutual funds alone, we saw over $40 billion of fresh investments coming in seeking risk, which completely negated this outflow which was happening in the FPI market. So much so that in 2022, India was one of the best performing markets despite all these outflows going through. More recently, October and November, we saw $14 billion of FPI outflows happening over a short 2-month period. The inflow which came into mutual funds during these 2 months, seeking risk, was exactly equal to $14 billion as well. So we've actually had a fantastic stabilizing effect on the markets. The volatility of our Indian markets has been low, and that is a draw for foreign investors as well. Having said that, as I said, no room for complacency. There's a long, long path ahead of us. So a couple of points I want to make. While we celebrate the growth of the domestic investor, this does not mean we don't need foreign investments. We absolutely require foreign investments, the point that Rajiv also made. So make no mistake, we have to ensure that we remain an attractive destination to draw in savings from the globe so that we can fund our future growth as well. Second, going forward as well, we can't take this inflow of fresh investors for granted. We've got to make sure that we not kill the goose that's laying the golden eggs, but we also preserve it. And there's a lot of work to be done there on an ongoing basis. I'm going to quickly touch about some of these things. One thing which worried us as a regulator was this mismatch between demand for paper and the supply for paper that we saw till recently. In FY24, the year that went by, if you see the amount of demand for paper coming through mutual funds and through FPIs, that was far in excess of the fresh paper being issued by way of IPOs, FPOs, QIPs, preferential allotments, etc. The mismatch was around 3.5 lakh crores. So, and which was a kind of a record of all times. Now, the regulator is the last person to talk about valuations, but when you have such a mismatch between demand for paper from these real investors and supply of paper, the question of asset, inflation and sustainability, etc., comes up. This year, I'm happy to report to you that the supply is actually caught up. We now have a record level of IPOs, FPOs, QIPs, rights issues happening. It's already a record for the entire year, even though we're only sitting in December. So till November, we've seen about 3.1 lakh crore of fresh issuances coming in, which is a record for all years so far in the history. The beauty is it's also accompanied by the record of all years for mutual fund inflows seeking risk. That's already at 4.3 lakh crores. So we are into a good thing of actually these two things going ahead. But as I said, we can't take this for granted. We have to ensure that we don't, we nurture this goose that's laying the golden eggs. So what are we trying to do in terms of improving supply and making it more efficient? We can't really address the real economy, but at least in terms of our processes, we are trying to ensure that IPO processes are made more efficient. SEBI is actually using its own in-house large language models to actually, and training them to actually process DRHPs and even PPMs of AIFs, etc., so that the efficiency comes into the actual IPO approval processes. When we talk about the number of IPOs that we do in India, and we speak to our counterparts in IOSCO and other countries, our numbers are staggeringly large, the number of IPOs that we are actually going through, and that process will hopefully continue in that sense. The second big theme for us, which you will see a lot of us speaking about, is investor education and investor risk awareness. There is, again, something that all of us in the ecosystem, whether it's AMFI, whether it's mutual funds, whether it's brokers, whoever, everybody in the ecosystem has to ensure that's done. We are worried that with the number of young people coming into capital markets, many of them glassy-eyed, many of them who have not seen an investment down cycle or a capital markets down cycle, is there really adequate risk awareness in the ecosystem? So what we are doing, by the way, we're doing a lot of work through AMFI, through the exchanges, through the clearing corporations, etc. But beyond that, we're also launching this survey, which we intend to use. It's a very wide survey across the country to try and figure out three things really. One, what does it take to get more people into the capital markets ecosystem? People who have fixed deposits, how do you get them inside? Is it about risk perception? Is it about awareness? Is it about access? What is it that will draw more people in? But it doesn't stop there. The next big thing is, how do you get them to be more risk aware? We want people coming in with their eyes open, not glassy-eyed and expecting to become millionaires overnight. So what is it? What is their level of risk awareness? Are they adequately informed about the risks and the volatility? And the third important part, what are the gaps as far as this inclusion is concerned, as far as this risk awareness is concerned? How do we communicate and bridge these gaps in the most efficient way? What language, what medium, social media, newspapers, television? So we're doing this large survey, which will hopefully inform our investor education and awareness programs going forward. The third area which Rajiv mentioned briefly, which I want to talk about, now that there is so much of acceptance of risk in this country and people are willing to come into the capital markets, I think it's extremely important that products such as InvITs, REITs, Munis, etc., start to show some traction. And you will see a lot of efforts happening from SEBI to try and make this happen. Monetizing existing infra, existing capital can be a great way of actually ensuring that sustained capital formation comes through. And here again, we will do a lot on education. We'll require the ecosystem to do that as well. But I think there are some areas where the industry should reflect as well. Things like, for instance, valuation of assets. Now, this is not a regulated domain, and as I said earlier, regulators don't understand valuation. We should not talk about valuation. But making sure that things like valuation, that there is no conflict of interest in doing the valuation, that there is sufficient disclosures of what's the assumptions behind the valuations, what is the range of valuations possible based on what assumptions you're making, and that there is sufficient accountability for your valuations, just as it is in the case of rating agencies. I think it's an area that we have to debate going forward. We don't want to get into regulating valuations, but if you want things like private equity, things like InvITs, REITs, munis, etc., to grow, I think that areas require some attention as well. Fourth, in terms of improving our efficiency, improving our transparency, reducing the risk in the ecosystem, we'll continue to work. Actually, our settlements and payment systems are the best in the world. Ashish is here. The market infrastructure institutions that we have are absolutely world-class. But there is still room for improving efficiency and reducing risk. One quick statistic, the amount of cash collateral or cash equivalent collateral from investors, from traders, from individuals, which is sitting in the ecosystem between intermediaries and the clearing corporations, is about 4.5 lakh crores on a given day, on average. It's like a mid-sized bank by itself. And it's lying not within the banking system, it's actually lying with either brokers or with intermediaries or with custodians and so on and so forth. Now, that gives rise to hidden costs. The reason why brokerage is close to zero is because you actually have float income coming from those balances lying with you. It also creates risk because after all, these are not banks. So while we have lots of checks and balances, don't get worried, we have lots of checks and balances, but we would still want to strengthen that. And third, it is not transparent. You really don't know what charges you're paying. Now, improving these things with things like optional T+0 settlement or the ability for you to trade by doing a UPI block on your balances in the bank so that you can trade against that, leave the money in the banking system, with having transparent brokerage or intermediary charges, which is in a competitive market, set perfectly in a transparent manner, I think can go a long way towards improving efficiency in the ecosystem. Finally, a quick one on FPIs, because a part of the topic was also FPIs. As I mentioned, we are working a lot to try and make life easier for investments into the country. We often get feedback that our requirements are onerous. We are starting to listen to that feedback. For instance, for one large category of FPIs, we've reduced the number of fields that they have to input while coming in for an application by 45%. By simply working with them to see what is it that is redundant and still meets all the regulations required. Similarly, we have a FPI outreach cell within SEBI where we have spoken to more than 600 FPIs, where we are getting a lot of inputs on what we can do to make life easier for them. Finally, I want to quickly reflect on the session which happened prior to lunch, which was on regulatory, the point about regulations versus innovation. There's a lot of debate that often happens that our regulations, are they onerous, are they too much? I can tell you our thought process on how we approach regulations. We are mortally afraid of two kinds of errors. The first error is when we allow bad things to happen. So when a Harshit Mehta happens or a Ketan Parekh happens, that's a bad thing. The question automatically comes, what were you guys doing? Why were you asleep at the wheel? So that's a type 1 error which we always want to avoid. But we are equally conscious, I can assure you that we are conscious of a type 2 error as well, where our regulations become so onerous that they come in the way of good people doing their work. Now, it's a very, very tough balance. Statistically, it's impossible to minimize both type 1 and type 2 errors, but I think in regulations, it's possible. There are win-wins possible where you can reduce both these errors. And this is where we need a lot of consultation. We try to do a lot of consultation. We have advisory committees that tell us on every single regulation that we come out with or we propose. We have discussions around that. Every regulation that we propose is open for public consultation. Once it's done, we actually put it out as a principle. Then what it translates into as do's and don'ts for the people on the ground, even that we do a lot of consultation. So we try and do this in a consultative manner. My request to CII and all its members would be a part of this consultation process. It can be very troublesome. It can sound like a lot of work, but it's important that we kind of minimize both type 1 and type 2 errors. I see the watch coming down to the close. Very quickly, we've had a fantastic run on capital formation with the advent of the Indian investor. I think that trend should continue, but there is absolutely no room for complacency. Lots of work to be done to ensure that the risks are managed, education happens, people are risk aware, so that the sustained cycle of capital formation can happen. For our part, I try and assure you that we will try our best to minimize both type 1 and type 2 errors on regulation. Thank you very, very much.
Thank you very much, Nanta. I think clearly, I think the track record over the last 3-4 years in the way, SEBI and all the others constituents have worked has really enabled, as you rightly said, domestic capital formation, which has given a lot of resilience to the Indian economy. I'm sure we'll have a discussion on type 1, type 2. I think that's a very interesting point. I'll now give it to Ashish for his initial remarks. He's the Managing Director and CEO of National Stock Exchange, and also is a very key player in the way the domestic capital formation and also international has happened in India. So over to you, Ashish.
Thank you, Rajiv. Anant, dignitaries on the dais, friends, it's a pleasure and honor to be in front of you. Speaking after the lunch and also after the regulator, all your points have been taken. So while he was speaking, I was thinking, okay, all these data points are gone now, what do I need to speak? So I will try to still keep you entertained. In some ways, India is a unique country. Per capita income this year, because GDP data is actually what I call very low frequency data. Once a year, that also after the year is over, 6 months after that. So it's extreme low frequency data. Whereas what we trade in the stock markets is in microseconds. 1 second has a million microseconds. So we give you response in a millionth of a second. Of course, in next year, probably 25 or early 26, we'll give you response in the nanoseconds, which is 1,000 millions. And so that's where India is today in terms of infrastructure. But in some ways, a country with $3,000 per capita, or probably by this fiscal year, and you will see India had probably $3,200 or $3,300 per capita income. The economic theory says that a country with low per capita income cannot have a well-functioning capital markets for equities or bonds, because the poor people cannot save, and if they save, they don't trust even their brothers. How come a person sitting in, say, 2,000 kilometers away in Jammu or Srinagar or Dibrugarh or Jorhat, which are remote, not exactly remote, they are urban areas of India, but anywhere in the remotest part. Today, NSE is present in all PIN codes without Jan Dhan Aadhaar mobile on its own. In all PIN codes except 30 PIN codes in India. There are more than 19,000 PIN codes. I have investors sitting in Andaman Nicobar. I have investors sitting in Ladakh, the remotest corner of Ladakh, and so on and so forth. And 30 PIN codes which do not have investors yet is because most of them are airports where nobody can give their address as a home address. But effectively, how did this market come about in India, which is anomaly? There is no similar market in the world at $3,000 per capita income per year. There is no similar market at $6,000 per capita income. There is no market at $12,000 per capita income. There is no similar market at $24,000. 8 times more per capita income and not a similar market, except one, which is China, where if markets go down, government A team has to go and do the buying. In India, do you think anyone buys here if markets go down? Why I'm telling you this is, this market is basically a market of the people, by the people, for the people. 77 years of independence and 30 years of NSE. NSE started operations on November 3, 1994. That time, India's market capitalization was 4 lakh crore rupees. That is, give and take few, probably $100 billion or $200 billion in that range. Today, after 30 years, it's $5.4 trillion. That wealth, which NSE represents today, with 10.7 crore or 107 million people, unique investors, is 1/3 of India's wealth. You take all gold, you take all real estate, you take all buckets and tumblers and everything, add up equities, and that is 1/3 of India's wealth. That wealth is the wealth of trust. That trust of an investor sitting in Jorhat or Dibrugarh or Andaman or Nicobar, putting her hard-earned 1,000 rupees, that is $10, into a company sitting in Salem, in Tamil Nadu, they are never going to visit that company, but they have a trust that that promoter, that particular manager is going to make profits out of money I am putting, and then a leap of faith that if the profit is made, that person will not run away or not eat it up, but also give me my small little share of that profit. It's such a great leap of faith, right? India has become more trusting of its entrepreneurs. It is an unbelievable leap of faith that a poor country with per capita poor sort of $3,000 per capita income is still trusting its poor other entrepreneurs. It is unbelievable. Nowhere in economics, I mean, there are books written why poor countries cannot have good capital markets. Now, giving you the other side of it, that I give you a response time in microseconds, there is no similar market in the world. I'll give you response time in nanoseconds, there will not be similar market in the world. But on a good day, I get 2,000 crore orders. That is 20 billion orders in one day, 15 orders for every human in this country. In single day, in 6 hours, 15 minutes. 2,000 crore orders is slightly larger than UPI does in a month, 24 hours a day, 30 days a month, right? On a good day, we will receive 50% of all orders in the world, all exchanges put together. New York, Chicago, London, Japan, add their brothers, sisters, and we'll still be 50% of the world. People are investing in India's future. And that's why the topic that financing India's future, I have no doubt that if India is going to grow, it's going to grow on the back of the National Stock Exchange. So yesterday I was at TIE, the Indus Entrepreneurs Global Summit in Bangalore, and I said that if you don't get funded by private equity, venture capital, whoever they are, pension funds, come to NSE, we will fund you. Thank you very much.
Thank you, Ashish. I think clearly what the NSE has achieved in terms of sophistication using technology, I think even if you compare some of the settlement times between NYSE, NASDAQ versus NSE, I think the gap is already phenomenal and we continue to improve. I just want to over here recognize the presence of the Honorable Finance Minister of the Royal Government of Bhutan. Thank you, sir. Thank you so much for joining. Mr. Lenopo Leki Dorji. Thank you so much. And I was seeing that you were making all the notes. And I'm sure if you have any questions for all these gentlemen, we will definitely give you that the opportunity of doing so. I will now request Mr. Shetty just joined us as Chairman, State Bank of India. He just joined us. Welcome, sir. If you could make some introductory remarks from here or from wherever you feel comfortable.
Good afternoon, everyone. Thank you, CII, for giving this opportunity. I think when I was asked to be present on the panel here, I was just wondering what is that we can talk to global investors who are coming to India. And just for some of you who may not be familiar with SBI, SBI is the largest bank in India. And any number in India, of course, is large. We serve a customer base of 500 million. The demographics, one of the pointers which CII team mentioned is our customer base is a reflection of the demographics of India. Highly diversified customer base. We have 150 million financial inclusion customers who actually started the journey of banking with a zero balance in their accounts. And today, 99% of these accounts are funded as we speak, which means that the financial inclusion objective, which the primary objective of financial inclusion of having a bank account is tremendously fulfilled in this country. And that is where I think it's, both Anant and Ashish have spoken in terms of how this financialization of savings from the banking system probably is flowing into some of these other investment opportunities. the moment Ashish keeps talking about nanoseconds, I'm worried. You know, there's already started, there's so much deposits flowing into the equity markets and SIPs. But it is inevitable in a maturing economy. We firmly believe that, you know, some allocation of the savings happens to this investment options. The way the bank like SBI has presence in every pin code, every village, every town, the way the investor community is spread out is a testament that, you know, this financialization of savings is happening. Important points to note is in terms of, I think, the financial ecosystem obviously is influenced by geopolitics, but I think India is very well positioned. During my interaction with several regulators, several countries, SBI operates in 29 different countries, and we feel that among many developed countries and developing countries, India is uniquely poised to be an investment destination. So that's on the demographic front as well as on the geopolitical front. And if you come to the, you know, productivity gains in the financial ecosystem, I think the tremendous work being done by the both banking regulator as well as securities market regulator is paying a rich dividend in terms of adoption of these new age technologies, including AI, not only for productivity gains, it is also in terms of the risk management. Today, huge customer base, and I'll just give you, I think, while Ashish mentioned about NSE's ability to handle transaction, the UPI, the digital public infrastructure which is created in India, has tremendously transformed the way the people transact today. On a payment system, on the maturity scale of 1 to 5, 5 being the best, I think it is one of the countries which is rated 5. And the direct benefit transfer, which is happening through the Jan Dhan accounts, the zero balance accounts today, our data indicates that 40% of this direct benefit transfer beneficiaries transact through the UPI. There's a tremendous adoption of the digital payment system. So this ecosystem of, you know, adoption of the DPI, proper regulation of the markets as well as the banking system, and the strong balance sheet, the twin balance sheet advantage of banks as well as the corporates, set a stage for India to attract, you know, investments. And in terms of the banking support for the growth of the economy, despite whatever challenges are there in the liability management, the banking sector is riding on one of the most benevolent asset quality life cycles today. The balance sheets of banks are strong and cleaner, and they have the ability to fund the growth prospects of this economy. And while the credit growth in many sectors is happening, I think the attraction of the renewable energy, again, which is another theme what is mentioned here in the sustainability front, both banking system as well as the corporate bond markets, I think, should contribute in terms of funding the sustainability initiatives of the Government of India. And Government of India is as committed for the net zero journey. I think is much ahead of the commitments what India is committed for. And we are playing, as the largest bank in the infrastructure financing space, our role in funding the infrastructure. And I think India continues to be a great destination for global money to come in. Thank you very much.
Thank you very much, sir. You're absolutely right. The twin balance sheet advantage today is a massive strength as we look at financing our future. Can I request Mr. P.R. Jayashankar, Managing Director, India Infrastructure Finance Company, if you can make some introductory remarks.
Thank you, Rajiv, and thank you, CII, for having me here. Good afternoon to all of you.
Yes, the speakers before me have already outlined the kind of attractiveness that the nation has, before us, and the kind of transformation that is taking place today in India is definitely, one that is very, very significantly attractive for becoming a destination for global investors. And infrastructure sector, all, the subsectors included, the roads, highways, the energy, all forms of energy, and the connectivities, the ports, airports, and all the other urban transportation, sanitation, and urban development, and the latest forms of data connectivities, the data centers, and the renewables, all across the board, there's development. And the kind of projects that we have are all very varied, and the national infrastructure pipeline has been drawn. Perhaps India is the only country which has such a number of vast listed projects across, and very, very transparently in the website of the DEA. 10,000 plus projects, 160 lakh crores, and 25% of them are public-private partnership. They are in PPP modes, making India the number of projects, in terms of number of projects, being the largest, PPP exercise in the world. And if we look at the journey, I would say we are in the version 2 of the infra development. The version 1 was, all learnings. And today we are in this position with a lot of learnings and rich experience, developing the first public-private partnership projects, learning by doing. We always have, done the projects with the experience of the previous ones, and considerable success at that. And the risks, again, the risk management, if you look at it, from the version 1 of infrastructure development to the version 2 that we are in, that has been a paradigm shift, and with a lot of, lowering of the risks, with the great, impetus on development of concession systems, the termination payments, and a number of other factors, new models, new financing models. The hybrid annuity one was one which we had, and the InvITs, and so many other factors which have enabled the development. And today we are seeing a new asset class. The erstwhile infrastructure projects which were being developed in the last version is now, up for monetization, which offers a very, very good opportunity for raising resources, and the financial gap which is actually perceived in the national infrastructure pipeline financing of about 15-16 lakh crores can be met out of this monetization. So that is the present dynamics. And a lot of financial interests. Today we are seeing global funds and the global investors in this assets. There are 23 InvITs, which forms a secondary market, and providing that much liquidity to, set the fundamentals more stronger. And with that, I think we are poised for the version 3, which would probably, be with more conducive regulations, more conducive structures, financial innovations. We have seen a number of innovations, financial innovations, so that, our concessions, which are today going at about maximum up to 60 years, 30 to 60 years, can go beyond that. Like the ones in the West, the Japanese lines, which are more than 100 years, the Channel Tunnel of UK, which is more than 100 years. All these things we are, we foresee the way forward with a very, very strong and robust banking sector, with the leading non-banking finance sector today in infrastructure projects, with their contribution more than 55%, with a good penchant for consumption, with very good economic structure. India is poised, and the world is perhaps witnessing a nation on the rise. So I think I'll stop at this and we can take the questions as we move forward. Thank you.
Thank you. We will look forward to hearing the version 3. Amit, can I just request you to be slightly more provocative? Amit is the founder and chairman of Bain Capital. I think he mentioned he's got the most efficient market in the world. He said he's the best domestic capital formation in the world. He said he's the best bank. Infrastructure is under control.
I don't know about being provocative, but when you come out to give a speech like this, reminds me of middle order batsmen coming after Sachin, Sehwag, Dravid, Ganguly, and there's 500 on the board and you don't know what more you can do. So I feel a little bit like that. But one of the questions I was thinking of is, when I was coming out here, someone told me, you go to all these forums, does actually anything come out of it? And I think Anant's comments and some of the points that Ashish made reminded me that those of us who've been working at some of these issues for 2-3 decades, that a lot can come out of it. Because in the last 15 years, for example, we've seen a 5% decline in savings rate, and that should have actually hurt us. But if you see India is actually doing remarkably well. And I think one of the reasons that has happened is that during the same period, we've seen equity and equity-related assets go up from, to about 28% of financial assets, which is almost double of what it used to be. And all of that is for the reasons that both Anant and Ashish talked about. And that's, I think, incredibly powerful, and it's happened because of policy nudges. It's happened because of all ecosystems, players, coming together. And I think, like, what both of them said, that's had a remarkable impact on India. I remember when I used to run India's largest investment bank in the 90s and 2000s, FIs used to sneeze and we used to get a cold. But now it's, you can withdraw $10 billion in a month and we'll power ahead. Markets remain open. And it's not just that. It's also the remarkable wealth creation that happens despite whatever FIs do. And I'll just give you some statistics. Anyone who basically invested $100 in the stock market in 2008, that amount compounded today is 538 rupees. And that asset allocation number would have been very different if your behavior wouldn't have changed, because that number would have been almost half if it was in fixed deposits and bonds, which is what your behavior would have been earlier on. And this is, I'm not suggesting anything against Mr. Shetty's business, but, because asset allocation still needs to be broad and diverse. But this wealth creation has truly been awesome for India, because when we think of $5 trillion of wealth, with a very large part of it resident in India, it basically means that even with this decline in savings rate, Indians have had this cushion where we have been able to continue to go and spend on consumption and felt good about our lives. So I think we should not forget that what policy nudges and coordinated action can mean for all of us. And I think that's really, really important. I think kudos to the regulators, people in MoF, and all the ecosystem players who've got together to make this happen. But I'll move forward, because we should always keep looking ahead and think about, 4 concrete suggestions that we need to think about for the road ahead. The first is, I think we need to really think about how we move insurance penetration up. Rajiv, something you and I were talking about just before this. We seem to be stuck for a long time in the 3 to 4% band. The world average is about 7. I think it's time we think about how we move from 3 to 4 to 7. I think this is important because we need a provision of long-term capital in this country. A lot of the capital in this country is still at the short end. It's really an imperative that we have long-term capital in India provided by Indians. For this, I think we need to think about policy nudges, particularly for the middle class and below, in terms of tax incentives. And I think the industry needs to maybe learn from the mutual fund industry, which has done a great job in terms of getting together and creating product awareness in a very neutral manner. So I think that's the first suggestion I have. The second is, we often forget how large EPF assets are. They're such a large percentage of our savings. Given how large they are as a percentage of the savings base, I think it's really a policy and a social imperative that we think about how we're going to deliver a fair return to savers from these funds in the future, so there is never the chance that they become a burden on the government. I think for this, we've started making the right steps in terms of thinking about raising equity caps. But I think we need to ask ourselves that, if foreign pension funds find great comfort in, high-yielding assets, equity, alternatives, credit assets in India, then we need to think about why should we not have greater comfort for our EPF assets as well. So maybe a more calibrated approach of raising these levels, because otherwise we'll have maramari in the stock markets. I think it's important for us to do that. My third suggestion relates to figuring ways to enable greater provisioning of long-term credit funding for infrastructure assets. I think we sometimes forget, and again, this is a point made by previous speakers, more infrastructure has got created in the last 10 years than maybe 30, 40 years before that. Now, there have been moves which, challenge infrastructure funding in India, particularly for Shettyji's business in terms of, the 5%, for example, provisioning requirement. I think it's really important that we figure how we are going to create a very stable framework for infrastructure funding in India. And I would suggest we do that both from domestic sources and international sources. For example, every year we think about, making tax exemptions for pension funds and sovereign funds. And right now we have one up to March. I think, people can't plan that way. So maybe we need to think about doing this for a 3 to 5 year basis. And importantly, we used to have in India, people participating in long-term infrastructure funding from domestic institutions and retail investors. We need to think about how to do that as well. And finally, I would like to turn to my own industry as well. Look, during the few years I was head of CII's P and VC committee, I began to actually grasp how large it had grown. It accounted for, as Rajiv pointed out, over 50% of FDI. And much of our celebrated startup boom, a very large part of the job creation outside of the conglomerates came because of investments funded by the PE VC industry. But I'm not making a plug for foreign capital, which I may represent. I actually think the time has come for us to shift to domestic capital. When I started my career in PE VC, 17 years ago, in China, it was China, which was the largest market outside the US, was completely dominated by foreign capital. Today, more than 90% of private equity raised in China is in RMB. That is staggering, right? Today, India's time has come in private equity. And India is perhaps amongst the largest and most important markets outside the US that investors look at. So question we need to look at, all of us stakeholders, be it policymakers, regulators, how do we create the most vibrant domestic private equity market? Now, this will be important because risk capital, just like the way we are no longer dependent on FIIs in our capital markets, we don't need to be dependent for risk capital on international investors. Just like the way wealth has got created, exceptional wealth has got created for domestic investors in our capital markets, we need to get wealth created for Indian investors in alternative assets. And this, I think, is very, very important. Time has come to start thinking about it. It'll be a long journey, but it took us, 20 years to get there. In capital markets, it will take us 20 years to get there in alternatives. I think that time has come. The policymakers are aware of this. I think they've done a very good job. There's a SIDBI fund, there's a SRI fund, SBI manages a fund for the government as well. So we know there are things that work, but it's time to double down on them. It's time to increase the scope. We need credit funds for MSMEs as well. And with that, I think if we really make a concerted effort, I have a feeling maybe we can shorten that 20-year horizon and do something spectacular in 10 years. Thank you for inviting me here, and my compliments for organizing a great event.
Very good suggestions, Amit. Thank you very much. What I'll do is, I don't think we have the time to ask individual questions. I'll put up some questions, and I would just request if, members in the panel, if they would like to respond. I think the theme is really financing future growth. Clearly, I think what we have achieved till now, especially in the last few years with the sophistication in the financial market, strength in the financial system, regulation and everything else, I think it's been quite, as I said, quite resilient, quite strong. But is it enough for India to be looking at 7.5% growth for the next 20, 25 years? And if capital to GDP ratio has to move up from 28 to 35%, government that's been front-ending a lot of the capex is on a fiscal deficit glide path. They want to sort of go down on fiscal deficit. They've been front-ending a lot of that. FDI, for whatever reason, has been it's stuck up at a certain level. So what is the kind of, what I would really want to hear, your perspective, whether this is enough, and Amit also mentioned savings rates have been going down. Is this enough? Is there something different that we need to do to be looking at financing the future growth? And any suggestions that any one of you have? I know Amit laid down a few of them, but if there are any other suggestions that you have in terms of ideas, suggestions, regulatory changes.
We are growing fast, no doubt about that. As compared to most of the peers, at least, particularly in the Asian region, we have good economic structure. But if we have to continue this, and if we have to look at the kind of achievements that we have to, reach a level of GDP to get into the quantum of size that the economy deserves, that, the 30 trillion and by 2047 and all that, Viksit Bharat. Great deal of attention has to be there in the reforms. I think reforms from the real sector is one side, and the financial sector reforms is also, it has to be conducive to, the growth. From the real sector, I can say that today we have definitely progressed quite well, particularly in the last 5 to 6 years, as far as infrastructure sector is concerned, because infrastructure, I would say the multipliers, if you look at it, 1 rupee of spending in infrastructure can lead to almost 2.5 to 3.5 rupees increase in the GDP. So definitely, it powers the GDP. So if we need to look at the rear sector, which has the reforms which have progressed quite well, the transparency, predictability, and dependency of cash flows, that has been quite well defined so far. The kind of props, the kind of support that the government has given, yes, it has been more powered by the government financing so far. But the paradigm shift is very evident that we need to move. The reforms which are being put in place is all to make the private sector investments come, and this is all underway. And the termination payments, the kind of changes that we have in the concession systems we have put in place, these are all, risk mitigant measures. And perhaps we have to talk something about the termination payment system, because having the largest PPP exercise in the world and having the road sector, occupy a dominant position in that, and a few other sectors which also offer termination payments, these are all again coming from the government's, budgetary resources. So this is again a big credit enhancement for the system that nowhere in the world, such a kind of push is there. Going forward, version 3, yes, I was coming to that we need to have financial sector reforms, particularly looking at non-banking finance companies, IFCs, infrastructure finance companies, with the same yardstick that is being applied to the non-banking finance companies in the retail sector is not really conducive enough. I think the regulator will have to take note of that and see that infrastructure-specific regulations can be applied into our economy as well, because there's a latest World Bank study which says 110 countries surveyed by the World Bank. I think this was out only in May 2024. Out of the 110 countries surveyed, 76% of the countries had infrastructure-specific regulations, and 56% of the countries surveyed had infrastructure-specific laws. So I think I think it's time for India to get these things in place, because predictability of cash flows, enforcement of the terms of contract, these will need to be served across the stakeholders' interest. I think these all have to, be put together. I think that will help, in getting more investor interest into this sector and the economy as well.
See, broadly, what you look at is that why do you require capital formation? Because it will create jobs and it will create growth, right? The framework, the way I look at it is slightly different, because the way we look at the economy is from the lenses of the rear view mirror. That it happened in the past, that's why it will happen in the future. Past is a good guide to the future, is a general purpose activities on all our mind. We think it happened in America, it happened in Europe, and stuff like that. But today there is a break. See, there are two significant sectors which have not been understood on the second part. The first part is what I call hard infrastructure, which is the ports, roads, airports, and every type of infrastructure, which including sewage lines. And so it helps you, at least there is a perception that will help you create more growth, more jobs, and other things. India is lacking in that. Hard infrastructure, India has been perennially lacking. And why? Is because we were capital deficit from independence and even pre-independence days, right? So we were not having that capital. We could not have invested. Now we are trying to make the hard infrastructure, all the ports and roads and whatever, at a breakneck speed, and hopefully in next 20, 30 years we'll make that. The manufacturing part, which we think is going to create jobs. And it's not that today we are thinking. We have been, in fact, Baba Saheb Ambedkar wrote about it in 1920, about shifting the agricultural labor to the industrial labor, because that time there were no services. Why I'm telling you this, we have been investing tremendous amount of money in industry, and we'll continue to invest because there is still a lot of juice left. But walking in the footsteps of somebody will be me too. We need to have our own strategy. We have created those strategies, the PLIs, and also we have now got some great short-term achievements in terms of manufacturing iPhones and exporting them. And so for me, the manufacturing is the second part which guzzles capital. Third part is agriculture. How much capital we can put in, how many people we can replace from the labor into the agriculture, into other areas. And the last part is services, which also in some ways dovetails into the soft infrastructure. Today, our hard infrastructure is pretty much not that great, but our soft infrastructure is the best in the world in terms of the public, private, everything. Today, $2 a month gets you 1 GB or 2 GB per day downloads. Most of us use it for watching movies, but also we do transactions and other things, right? And so for me, the next future growth of the jobs and also what you said, 6.5, 7, for me, it can go to 8, 9, 10, because the technology is going to create that wealth much faster, because technology waves are coming faster, the wealth gets created by technology, and that's where the soft infrastructure, the country which has it, is going to create more digitalized assets, whether experiences, AI, and what have you. And for me, that is where India is best place, where you put in little meat and you get a lot of output. And that is why I call it non-linear outputs or non-linearity of payoffs vis-a-vis the physical infrastructure, physical manufacturing. They are in a way linear. You put in a lot of money and hopefully you will get a lot of money out. Whereas here, you put in little money, you get lots of money out. And we have so many examples of that happening in India. Say Infosys, very little money put in, now so many people are billionaires and many more millionaires and others. And that is true with Zomato and Swiggy and whatever you have. And that's why if you separately think of them, that services we are doing well, should we think that it doesn't require any investment at all? Or it doesn't require any nurturing or sort of exports and stuff like that? That's where for me, if we take all of that combined, we need to do investments in the infrastructure, in the manufacturing and other things. But also, let's not forget services. And also, on top of that, the dematerialized services, the newer gaming and everything else that is going to come, which is going to create more wealth in the future, we need to also focus on that.
Yeah, I just want to build on a point, striking point Anant made during his remarks. And I think in that lies probably the biggest opportunity for India. You know, he said that they have cut, for example, in one process alone, 45% of the data that people had to provide to achieve the same process requirement that earlier on, SEBI required. I think in India, our biggest need is ease of doing business. If every department, state, or center, every regulator can basically cut its process requirements by 50%, and we can chop regulations by half, you will unleash such animal spirits in this country that all the people who are nascent entrepreneurs and all the people who basically are spending half the day running from pillar to post, filling forms, they will suddenly start becoming productive.
If I can just add to all the comments so far. First off, on savings, Rajiv, both you and Amit mentioned about savings being on the softer side. Incidentally, we are in touch with RBI and MOSPI. We actually have ground-level, bottom-up savings data in our securities market ecosystem, which doesn't require estimation, which is the norm in the other countries. So you will see some, hopefully, changes coming out in the savings number. But I think the larger point is it's very clear within the savings mix, the saver moving to investor, the capital market part of the savings is definitely on an upswing over the last few years. So I think the savers moving to investors are doing their bit for capital formation. So much so that frankly, as a regulator, our focus is on ensuring there is risk awareness, ensuring that people are not coming in with their eyes closed, and ensuring that a lot of money and time is spent on things like cybersecurity, information security, risk awareness, education, and so on and so forth. I think the time is now for the issuers. If the risk, if the investor is available now with the risk capital, we need issuers to step in and raise these funds now. We are seeing a bit of that. As I said, we are seeing record level of equity raising this year. It's a complete record not seen in the past, already 3.1 lakh crores. But beyond, and I want to echo what Mr. Jaishankar said, things like InvITs, REITs, munis, essentially monetizing existing operational capital so that you free capital for generating fresh capital. One estimate that we did within SEBI is that the total potential market size of things like InvITs, REITs, monetization of existing capital, the market cap of that can be as high as our GDP. We are a fraction of that currently. So I think doing the education, doing the building the trust, making sure things like valuation, things like whatever it is that is required to build in the trust, and of course the larger education, so that these instruments for actually raising capital and then converting them into productive use, I think the ball is frankly in the issuer court, many of whom are here in the CII community. The last bit I want to add to what Amit said. I don't disagree that making sure that regulations are facilitative, as I said, the type 2 errors, reducing the type 2 errors, I completely agree with that notion. I'll tell you what our challenge is sitting in SEBI. We are, as I said, mortified by the prospects of both type 1 and type 2 errors. We get very nervous when we see lobbying entirely on type 2 errors or reducing them, turning a blind eye to what we see as very, very consequential, obvious cases of type 1 errors. My request to CII is the following. One, it's a very noisy world, particularly in this world of social media, where the amount of advice we get every day is just immeasurable. We have to sift through it. So you as CII, you could do us a great service and do yourself a great service by getting some degree of consensus and presenting what you think is a policy prescription to reduce the red tape and so on and so forth. Second, along that, please be a trusted advisor. Before we find out through our inspections or through some friends in the media or through some other intelligence that something egregiously wrong is happening, tell us it's happening. This is not snitching. This is purely saving the ecosystem. It's not a question of morality as well. I'm simply saying anything that goes wrong actually threatens the trust in the ecosystem, and the saver who's becoming an investor can be put off by that. It's a matter of preserving that ecosystem and not killing that golden goose. Please tell us if you see something, say something. So both of this, be trusted advisors, if you see something, say something, and advise us once you've gained the trust as a trusted advisor. Tell us what changes you would want. I'm sure we would be much more open in our hearing then.
Thank you very much. Excellent points. I know we have completely run out of time, but if for 2 minutes anyone wants to comment on bond markets. I know we have a very sophisticated equity market, but the bond market is relatively still not developed.
I wanted to say something about bond market. I'm glad, Rajiv, that you've asked that question. When we are talking about savers becoming investors, and much of this investments is not only happening in the equity markets, it's going to the mutual funds, it's going to the pension funds, it's going to the insurance funds. So I think we've been debating on the depth of corporate bond market for so many years, and we could never achieve that depth. I was just looking at SBI is the largest issuer of the corporate bond in the current market. And I'm sure that there are a lot of corporates would like to issue the bonds. We have issued about 50,000 crores worth bonds this year. But I definitely believe that if the savings, household savings, or corporate savings, are finding ways into these three investment categories, it is important that the pension funds, the insurance funds, and the mutual funds also actively participate in the corporate bond market. I don't see that kind of participation actively coming in. Even if it is coming in, it is coming, near sovereign risk, or AAA bonds. And that is not really going to help in terms of deepening the corporate bond market. And eventually, even when you talk about the infrastructure financing, there's only so much the commercial banks can do because of the ALM mismatches or the ability to fund long gestation projects. So somewhere the corporate bond market has to come into the financing of infra as well as the balance sheet funding of the corporates. I think that's very much required. One piece of important enabler what RBI has given is for the banks particularly to put the corporate bonds into HTM category, held to maturity. But we still have been negotiating with RBI that even if I put in the HTM, I still have priority sector obligations on that, which means that it's going to really put pressure on us. And I'm sure, I think all of us have to really think how do we deepen the corporate bond market.
Thank you very much, sir. I think we need to now close. Can I have a round of applause for an excellent, outstanding panel? Thank you very much.
Thank you, Mr. Memani. May I request you to kindly hand over a token of appreciation to each of our panelists, please? And then we'll have a photo op and close with that. Post lunch, the applauses should be. Thank you so much. May I request the panelists to please step forward and have a photo opportunity, please. Ladies and gentlemen, with that, we'll move on to the next. Right away, as soon as we've just turned the table around.